can we still find positive cash flow properties in this market? Well, there's a few things on there. I mean, the general consensus will probably be no from my end, but there's a few things to kind of peel back. I mean, at the moment, interest rates in general are around about 6.5% across the country, and it's going to be heavily driven by the deposit amount you're using, right? So if you're using a 10% deposit, which most investors are going to use through that purchasing space, it's unlikely you're going to be definitely not going to be getting a positive cash flow property. Uh, and there's other things that you could take into consideration as well. So if I just give you a bit of an example, and you know what, don't ask me why the heck I did a $525,000 property value. I think it was because, actually, I do know why. It was because that was the median price we purchased recently. And if we've got two scenarios here, the one on the left is just dealing in the real. As Ian, our GM of sales, like to say, we're dealing in the real. These are real numbers of what it's actually going to cost for you today to actually service a property. So if you go out there and purchase a property at $525,000, you're going to have your property management fees. You're going to have your interest rate at 6.5% more than likely. You've taken out your loan at 90%. And you've got your tax rate. Maybe you're at 30, maybe you're at 37 or 45. I've just gone at 37. The average yield we're getting is around about that 5 to 5.1 number. Then you've got all your running costs of that property. So council, water, insurance, maintenance, property management fees. And once all that's said and done, even after tax deductions, you're out of pocket around about circa $140, $150 a week. Now, potentially you're using a larger deposit. Potentially you've got that property has a little bit of depreciation on it. I wouldn't expect the world of a lot of depreciation on a $500,000 property, but even still, it's not going to be a positively geared property. Now, if you look at the right scenario, and I'm hoping it's on the right for you guys, it's not inverse on me, but the only way you really get to a neutral or positively geared property is you need to be at that 7.65% rental yield. Now, I did a review earlier. I can assure you that over the last 12 months, we purchased precisely 0 properties at 7.65% rental return or higher. So not saying they're not out there. They're definitely not in the type of properties that we are going to be interested in purchasing. There might be in a 1-bedroom service apartment, or maybe in an NDIS property, potentially. But I guess for us, and what we don't want to lose sight on, and is really that capital growth is what we focus on and what the algorithm focuses on as a primary function in terms of growing our clients' wealth. So this here, Ian was kind enough over the Christmas break to analyze hundreds and hundreds and hundreds of properties individually. And I can pretty much guarantee you there's not many out there that are willing to openly share their actual results on a year-by-year basis. They'll share you their case study here or there. But these are properties purchased and their compounding annual growth rate from year of purchase. So the algorithm is quite heavily weighted for the first, kind of handful of years to be the most aggressive in the performance window. And that's really what you want if you're wanting to fast track your returns, right? Most people, when they're getting into the property space, they're looking to get from point A to point B. Now, whether that's using the equity growth in their properties to leverage from one property to the next and building out a portfolio, or whether that's, selling that property off after a handful of years to pay off mortgages, or maybe they're going down a rent vesting pathway. But whatever it is, that first handful of years performance is going to be the make or break of what's going to speed up your property performance. So even properties that we purchased all the way back in 2018, they've had a compounding annual growth rate now of over 10.5% per annum. And these properties here comfortably, even some of these are before COVID, and then we've got after COVID. So for us, and I guess back to your question there, sorry, Pramod, for us, capital growth is really where you're going to make your wealth. If we're worrying about making $50 a week or $100 a week on a cash flow positive property, you can keep your $2,500 or $5,000 per annum. I want really big returns, particularly when we're investing in property. We're dealing with a leveraged asset. We're putting down a 10, 20% deposit, and the bank is giving us the other 80 or 90%. So our returns are really magnified by that leverage. This is where I want to be. I want to be seeing that, after a handful of years, my property's nearly doubled in value. That's where you're really going to see your returns. But thank you for flicking that question through. And yeah, again, we just like to deal in the real here. Cash flow positive properties, great if the market allows us to do that and interest rates are at 2 or 3%, but that's not where the market is right now. So we just want to keep what our main focus is, which is wealth creation. But thank you for flicking that one through.